Hi, this is Sean O'Hara with Pacer ETFs. We're going to do a little brief discussion on the key differences between mutual funds and ETFs. The first thing that people need to understand is that mutual funds and ETFs live inside the same regulatory framework. It's the 1940 Act. So from a regulatory perspective, they're basically governed by the same set of rules. There are, though, some key differences between mutual funds and ETFs. So let's start first and foremost with mutual funds. What I want everybody to think of is this little bowl here in front of me with all these M&Ms in it as a mutual fund. So I'm going to move this one out for a while. So this is our mutual fund. And the advantages of mutual funds is that it allows investors to be able to own a piece of a diversified investment. So with a relatively small amount of money, they can own lots of different stocks or bonds. And in some cases, they can have their mutual fund managed by a professional, and hopefully that professional manager over time will produce returns that are attractive in line with what the investor's objective is. So with regard to a mutual fund, though, there are a couple of things that we think people need to know. One of the disadvantages of a mutual fund is that if I wanted to own a mutual fund, the way I would buy that is I would buy it directly from the mutual fund company, and I would put my order in during the day. And that order would be filled at the closing day's price. The other big disadvantage of mutual funds versus exchange-traded funds is how they operate with regard to activity inside the fund. So if you can think of this fund, if you will, with all these M&Ms in it, and those M&Ms represent individual stock holdings, if the portfolio manager during the year decided, for example, that they wanted to get rid of some of the orange M&Ms, which might be one stock, and add, let's say, some more green M&Ms to the mutual fund, they would sell the orange M&Ms and they would buy the green M&Ms, and they would now be in that client's pooled investment. However, the 40 Act requires mutual funds to keep track of all of those buys and sells during the year. And if at the end of the year they wind up with more sells that resulted in profits than they do sells that resulted in losses, then those additional gains must be distributed to the shareholders. So one of the inefficiencies perhaps in a mutual fund is that you really have no control at the end of the year whether or not you're going to pay additional tax on your holdings. One of the big issues that's been going on here lately, though, is that because the ETFs have arrived on the landscape inside of the 40 Act, mutual fund investors are now seeking more ETFs as the solution as opposed to mutual funds. We've seen this in the rise of ETF assets and the relatively slow decline in mutual fund assets. And so even if the portfolio manager doesn't decide, for example, that they're going to change their portfolio, if somebody who owned this mutual fund decided that they wanted their money back, the manager would have to start to sell individual stocks in that particular fund in enough of a dollar amount to meet that individual investor's redemption request. When they sell those individual M&Ms, the orange, the green, and the blue one that represent individual stocks, that might result in additional capital gains distributions. Exchange-traded funds work differently. Essentially, they're the same thing if you wanted to think about it. They're a pooled investment that an individual investor can put their money in, where there'll be a diversified portfolio of holdings. However, at the end of the year, typically exchange-traded funds won't distribute capital gains, and it's important to understand why this is. So, for example, if this particular exchange-traded fund that we have here, represented by this bowl and all these M&Ms, was following an index methodology which required it to rebalance, let's say, on a quarterly basis. And the rules of that rebalance dictated that they were supposed to get rid of some orange holdings and add some more blue holdings, let's say. At the end of that quarter, what would happen is that the ETF issuer would work with the market maker. And they would say, for example, that I need to get rid of these 2 orange M&Ms. In exchange for that, I need you to give me 2 more green M&Ms, let's just say. So the way that that would work is that market maker would go out into the market on their own, and they would buy those 2 little green holdings. Those are going to be the new holdings of the exchange-traded fund. And they would send us those, and they would go into the pile for the first day. And then the next day, that market maker would say, well, now I want to redeem shares of the ETF. And in the redemption basket, we're going to put the 2 orange ones that we don't want, send them back to the market maker, and the market maker is going to sell them in the open market. What I want you to understand is how things worked here. None of that buying and selling activity took place inside of the ETF. And so therefore, we don't have to worry about capital gains distributions at the end of the year. The exchange, if you will, of those 2 little custom baskets where the market maker gives us what we need the first day, and then we send them back what we don't need anymore the second day, is called a custom in-kind creation and redemption. And that's one of the key features that makes ETFs more tax efficient than mutual funds. The other advantages might be lower cost and the ability to buy and sell shares during the day. So like on a day like today when we're recording this, and we had a big market movement, for example, in NVIDIA. If you thought, hey, I really want to buy this ETF because it has a big holding in NVIDIA, if you bought a mutual fund, you'd get the end of the day's close, which might be higher than NVIDIA's price today. With an ETF, you can buy it right now and get that price. So those are the key differences, if you will, between exchange-traded funds and mutual funds. And we think that the combination of advantages, buying and selling during the day, lower cost, and then the big tax advantage, more tax efficiency than mutual fund, is what's driving ETF assets up while mutual fund assets continue to dwindle.